Good morning. My name is James Neathery. I'm with Neathery Associates. I'm glad y'all are here. Is most everyone here from Houston? No? Yes? No? Where y'all from? What? GFW? Us too. All right, so really we're from all over. You traveled in, right? And we did too. And exactly the reason why we did is because, y'all are outside of the box thinkers, real estate investors, right? Entrepreneurs. You understand cash flows, leverage, and in general, you're cool people. And I'm not trying to patronize you. Okay, a little bit about me. 25 years in the life insurance business and an investment advisor. And I know y'all didn't get up today to talk to a life insurance guy, but about 14 years into my career, and I was at least moderately successful. $1 million round table producer, top 5-10% in the country. I might not have been the last guy in line, but I wasn't the first. Might not have been the first guy in line, but I wasn't the last guy in line. Okay, now I'm a student of my faith, my profession, history, and economics. And I have learned and am convinced that you cannot separate history from economics. Behind every great historical event, there's an economic side to that story. Okay, so now, being a good student of my profession, about 12 years ago, I went to a conference, had a bunch of outside speakers all over the country, sharing best ideas, best practices to provide better service for their clients, financial guys, right? All the financial gurus. And so I went, and I'm taking copious notes. It was a 2-day event, okay? And I'm there as a student. At the end of the event, I bought all the books that the speakers referenced, and I took them home because I'm going to read them to educate myself, to provide better service to my clients. But then, in my practice, I deal with numbers and concepts all day. So when you go home, you're essentially trading family time for more numbers and concepts, right? So I would start reading a book, and then I wouldn't finish it. And I didn't even start reading the books, this stack of books that I'm facing every night when I go to bed, stacked up on my nightstand. Right? I'd start reading, and I started without finishing about 5 books. Now I'm feeling like an underachiever, right? So I go through the stack of books, and I pick the thinnest book out of the stack. The only reason I picked this book to read so I could read it and finish it. And I read the book that night and could not believe what I didn't know. In my profession, 14 years, at least moderately successful, and I had no idea what you could do with dividend-paying life insurance. Man, I was as mad as you could be. But I got up the next day, and I thought, man, I have clients, they need to understand this, or they need to read this book to see if they see the same thing that I'm seeing. Right? So I got up the next day, I called the number on the back of the book, and the author of the book answered the phone. Right? Beautiful man, Southern gentleman, Birmingham, Alabama. The conversation went essentially like this. It ended this way anyway. Boy, I hold these 10-hour seminars all over the country, and you need to get yourself to one. So I did. I went to the very next seminar that he was holding, and I went as a student, took copious notes. Flew home. Now, this was 12 years ago, over 12 years ago now. Flew home and restructured all of my life insurance and have been teaching my clients how to implement the infinite banking concept ever since. All right. And it's not about me, it's about y'all. The only reason I'm here is because you're outside of the box thinkers. What I'm going to talk about is conceptual, and really my challenge is to bring numbers and concepts together, right, without beating you up with numbers. Look, I married a beautiful girl from Iowa, up north that, snows like crazy, and, they study a lot. She's an English major, smart as a whip. If I start talking about a lot of numbers, her eyes will glaze over, right? But then when she corrects my Southern English, my eyes glaze over. So the challenge really is bringing the concept and the numbers together. Okay, but the only reason I'm here is to encourage you to look deeper at this concept that I'm talking about today with an open mind. Okay? And I want to start. Look, the IT guy's in the room. Look, he's bringing up the PowerPoint, maybe. How far are we away, sir? A little bit. Okay. I don't even really need that, but, you know, it gives me something to look at and keep me on track, right? I want to talk about qualified plans for a minute because there's got to be a comparison or some kind of a contrast. I'm talking about the infinite banking concept, so I want to contrast it with the qualified retirement plans. And the reason is, most all of Americans, we hold our wealth, the majority of our wealth, in qualified retirement plans in our primary residence. Right? We're all taught to work hard, save money, and invest in the stock market, and oh my gosh, get a tax break while you're doing that today. Tax break today while you're investing. And I want to talk about qualified plans for just a moment. In the late 80s is when the qualified retirement plans came out. 401k, the 401k, right? The government said, well, the Americans, we're not saving enough money for retirement. We don't want them to age and become dependent upon us in Social Security. So we're going to give you a tax break today so you can save for your retirement in the future. Right? Okay. They're going to give me a tax break today to save money for my retirement in the future. If they had my best interest at heart, wouldn't they have just lowered my taxes to begin with? Yeah, the qualified plan isn't necessarily, what we're told that it is. But look, primarily the traditional qualified plans, the IRAs, 401ks, 403bs. I'll talk about Roth IRAs, and we'll talk about self-directed IRAs briefly. But the qualified plans beg three questions: are taxes going to go up in the future? Or are they going to go down? Oh, of course they're going to go up. I got a beautiful 1913 1040 form that, you're awesome, man. Looky there, I'm right on track. And y'all are the smartest people in the room, right? Of course taxes are going to go up. 1913 1040 form. You might not can see the numbers, but look, you could earn a $20,000 in income in 1913 and not pay any taxes. Between $20,000 and $30,000 in income, you'd have only paid 1% in taxes. The equivalent today is we can make $120,000 to $150,000 a year and not pay any taxes. Right? Brackets change, deductions, exemptions, carryovers, exclusions, all of that changes, but the net amount of money that we're paying in taxes continually goes up. And maybe your case is different, right? The second question is, would you rather pay taxes on the seed or the harvest, a little or a lot? On the seed, right? That is exactly right when there's variable returns, but when there's linear returns, if you could earn 5% this year, next year, if it's a linear return, it really wouldn't matter. But returns in real life don't come that way, right? They're variable, so you would want to pay taxes on the seed a little versus a lot. But look, the third question, is a dollar worth more today or in the future? Today, always today. And now, here's the way I like to explain it or use the example. When you were a child, how many candy bars could you buy for $1? A ton. You know you should have been buying apples, right? How many candy bars can you buy for $1 today? 1. If you go to the dollar store, you should still be buying apples, right? This is what happens if you buy candy bars. All right, so $1 is always worth more today. So the qualified plans violate those three simple truths. Taxes are going to be higher in the future. You're going to be pay taxes on a larger amount. That's if the underlying investment did well and grew, right? And then the dollars you receive at withdrawal are always worth less in the time of contribution. Now let's look at the Roth IRA. Okay, the Roth IRA still violates that third truth because the dollars you receive in the future, even though they're not taxable under current law, they're still worth less than the dollars that you contributed. All right, and then your income. You know, you got to qualify for the Roth, and then you're always limited on how much you can put into a Roth. Now let's talk about the self-directed IRAs, Roth IRAs for a minute. You know, the cost of compliance is becoming more and more expensive, and the compliance itself is becoming more and more onerous to have a self-directed Roth IRA. And that's exactly why you're in the real estate or looking in real estate, because you know these things are true, like the inflation, the loss of the purchasing power of the dollar, you know, and you're trying to get a higher rate of return because you don't trust the financial gurus 8,000 miles away, right? No question. I agree with you. Let's take a closer look, though, at the timeline of a qualified plan. And my example, I've got someone going to work at 19 and a half. For the next 40 years, they've effectively locked up their money when they put it into a qualified retirement plan. Because if you access that money, you're going to pay a penalty plus ordinary income tax. Now, I know, everybody knows, you know, you can borrow $50,000 or 50% of your 401k. Right, but you tell me who controls that loan. Not you. They do. Right? You lose your job, you do whatever, then that becomes a taxable distribution. All right, so you're going to lose, if you have to access your money, you lose between 35 and 45%. But look, once you turn 59 and a half, you enter into this magical 11-year period. You can take as much out, as little out, as often as you would like without any kind of a penalty, but it's still 100% income taxable. Then you turn 70 and a half. My example, I let you live to 100 over that 30-year time period. If you don't take out on an annual basis your required minimum distribution, you're going to pay another penalty of 50% of what you should have taken out, but you didn't take out. Now, I don't know what the liquidity on a 100-door real estate portfolio is when you're 70 and a half. Right? And how liquid it is, and you satisfy that need. I'm sure there won't be any issues. The only issue will be complying with the qualified retirement plan rules. So that means over 80% of the time, the plan owner's in a penalty phase. Now look at this, 45% all the way up to 70%. 45% of all plan owners liquidate their qualified retirement plan prior to retirement. That's a Fidelity investment statistic. And then in 2009, 10, and 11, that went up to over 70%. Now you think about that. Why would anybody put money in a qualified retirement plan, to get a tax break? Why would they access it or liquidate it prior to 59 and a half and pay 30 or 40%? Right? Because life happens. They moved, they had an accident, a sickness, education, whatever it was. And now think about this too. If the majority of my wealth is in a qualified retirement plan and my primary place of residence, I'm separating myself from the majority of my capital. Now I'm limited what I can have access to in the qualified plan. And then I'm also limited to how much equity I have access to in my primary place of residence. In either one of those situations, I don't control that loan. All right? Does that make sense? Okay, that's qualified plan. And I don't have anything but easy questions for you. You tell me who that plan was designed for. Right? Of course, it's the IRS. It's nothing but a long-term pool of money that the IRS is going to access and make you liquidate within your lifetime. And if you really are honest with yourself, looking at a qualified plan and the rates of returns, by the time you retire and start taking distributions, out of that whole balance, 1/3 goes to management fees, 1/3 goes to taxes. That leaves you about 1/3 of that account balance, and about 1/3 to half of that, your third, is going to be devastated by inflation. And this is where we're supposed to build wealth, right? Oh, well, you're going to make it better because you're investing in real estate? I agree with that. You'll make it better investing in real estate, but you're still dealing with the rules and the regulations of an exception to the Internal Revenue Code. All right? Okay. Now look, all the plans violate the law of use except for your self-directed Roth IRA. You know, you tie your right hand behind your arm for about 6 months and don't use it, you will lose the ability to use it. All right, so most of the time, over that timeline, you're in a penalty phase, you pay all the fees and you assume all the risk. Well, what's new in America today, Mr. Consumer? Right, we always pay all the fees and assume all the risk. All right, that's the comparison to the infinite banking concept. I would encourage everyone in here to purchase this book and read it before the sun goes down today. All right, you can purchase them here, you can purchase them online. It's an easy read, 92 pages, big print, lots of illustrations. It's an easy, it'll be so easy it'll probably make you angry that it's so easy and you never heard of it. Okay? Now, my IT guy's gone. I'm sorry? I have an hour? That's not what the schedule says. I'm sorry. The book, online, the book retails for $21.95. Okay? While you're buying the book, you should also purchase this DVD. This is a documentary style film. It's completely unscripted. It is not a commercial for me or anyone else. I'm in here, but there's some other financial guys in here. Nelson's in here. Two of the top Austrian economists in the country are in here. Is anybody familiar with Austrian economics? It's the exact opposite of what we have going on today. And if you look at this infinite banking concept, this is Austrian economics in action, where I control the banking function in my life, and I have the best hedge against inflation that man has ever created. Okay? This book, the long answer to a short question, right? This book this DVD is $14.95 plus shipping online every day. Sells all over the country. Today, we have the book and the DVD for $30. That's my cost, right? So I'm almost giving it to you, right? So the short answer is $30 for the pair. Okay? Now, for this concept to make sense, you have to have some basic understandings. And you know, God bless y'all, I wish I was an IT guy. I'm not an IT guy. Go get the IT guy. I mean, my God, they have a list of speakers. They ought to make it easy for them to share the information that y'all came to hear, right? Okay. Let me say this. You finance everything you purchase. You either formally finance and pay somebody else interest, or you pay cash, right? And then you lose interest you could have otherwise earned. There are no exceptions to that, whether you recognize that or not. Richard Cantillon discovered that in the 13th century or the 14th century. You either pay interest when you finance, or you lose interest when you pay cash. Well, the fact is you financed everything you purchased. There's a finance cost to everything you purchase. Does that make sense? Okay, now let's think about that for a minute. The cash buyer pays cash because he doesn't want to pay anybody interest. Now let's look at a $30,000 purchase. I'm using that just because I know the numbers. Okay? And it doesn't matter what it is. It could be an automobile, it could be a piece of equipment, it could be a piece of real estate, it could be a real estate option, whatever it is. It could be like if it was a piece of equipment for a business. If I'm a business owner, I'm making an equipment purchase. I bought that equipment so I could be more profitable. I'm not talking about those profits. I'm only talking about the purchase price of the equipment. Does that make sense? Excuse me. So if I paid $30,000 for anything, and I could have earned 5% with a safe rate of liquid return, all right? Liquid money, safe rate of return of 5%. That $30,000 over a 30-year time period would have grown to $129,000. Or the financing cost of a $30,000 purchase over a 30-year time period. Does that make sense? Now look, the further out I go, the bigger that number would grow. Right? And I'm just trying to isolate some numbers here. There is a lost opportunity cost to every dollar you spend. Well, this concept allows you, shows you, methodically teaches you how to recapture the equivalent of that lost interest. Does that make sense? Okay. Now that's paying cash. If I formally finance, I'm just out and out paying somebody else interest, and it is never going to come back to me. Ever. Okay. Now, this uses dividend-paying life insurance issued by mutual companies. Is there anyone in the room that can't get past the word life insurance? Perfect. See, I knew y'all were smart people, outside of the box thinkers, creative entrepreneurs. You know, words have power, words have meaning, but they're not scary, right? Okay, now, go with me on this. You're taught as a consumer, when it comes to life insurance, to buy the biggest death benefit you could possibly buy and put the least amount of money in, pay the least amount of premium that you could possibly pay. Right? Buy term, invest the difference. This is the first paradigm shift in thinking. We're using life insurance because of the characteristics of life insurance. And we're trying to get as much cash in as possible with the least amount of death benefit. Because all of the expense in life insurance is in the death benefit. Right? Now, if I do that, I'm just creating a pile of cash inside a life insurance policy. That's the purpose. Okay? The infinite banking concept. Infinite is unlimited, right? This concept is only limited by your imagination, I assure you. Banking, the word banking, look, I'm told banking, the root word of bank is bench, right? Goes back 6,000 years to the temples. Worshippers would come, they pay their tithes, their homage. The money changers worked off of a bench outside of the temples. Okay? The root word of bank is bench. Now look, remember the girl I married from West Des Moines, Iowa, up north? Gets real cold up there, snows all the time. They study, they're real smart. You know, when it snows in the wintertime and the snow piles up, Jake, don't worry about that. Just leave that. The snow piles up against a barn or a building. What do you call that pile of snow? Come on, y'all. Y'all been up north. A snowbank or snowdrift? Right? A snowbank, right? Now, if I'm floating down the river in a canoe and there's a pile of dirt on both sides, what do you call that pile of dirt on both sides of the river? A riverbank. You probably fished from it before, right? A riverbank. Now, if I go give blood tomorrow, where am I going to go give blood? A blood bank. So bank can also be an aggregate of any one thing. Right? Okay. Now we go look to Webster's. What's the definition of bank or banking? And it's going to talk about deposits, withdrawals, loans, loan repayments, the movement and the flow of money. Right? Okay. Now we're going to take a life insurance policy by the least amount of death benefit possible. We want to eliminate as much of the cost and expense as we can, and then put as much cash into that policy. Now we've created a bank. We have aggregated money. It is the aggregate item in that policy. Right? Now we're going to use that money to finance everything that we were going to finance anyway, which is everything you purchase. Does that make sense? Okay. Now, if I put money into the bank, if I deposit money into the brick and mortar bank, we're good. Yeah, we're fine. Thank you so much, though, for checking on us, okay? I put money into the brick and mortar bank. Do you know what the bank is going to do with that money? They're going to loan it out? You know, they don't lend their money. Their money's tier 1 capital. It's too valuable for them to loan. Their money is on deposit, earning guaranteed interest on guaranteed payback schedules. Right? They lend your money. But before they lend your money, they print money out of thin air. Fractional reserve banking. You put in $100,000, they're going to create money out of thin air, and they're going to create about $900,000 out of thin air on your deposit, and then they're going to lend that money. Okay? They create all kinds of portfolios, right? Automobiles, home mortgages, real estate, second mortgages, student loans, whatever it is. Then they put that money into motion, right? So some of those loans are going to be repaid, some are going to be defaulted, some are going to be paid early, and others are going to go to term. But that money in motion, over and over. You know, here's another way. If I go buy, it doesn't matter what kind of car, a Ford automobile. You tell me who is most profitable, the manufacturer, Ford, the dealer who sold the car, the salesman who sold the car, or the entity that financed the car. Right, the banking part. The banking industry is the most profitable industry on the face of the earth. Okay, so I digress. But when you put that money into a life insurance policy and you put enough of it in there to make purchases that you are going to make anyway, and then you do that over and over and over. You know, most of y'all in here have been driving cars for 20 years. You're going to drive another 20 years. You probably buy cars on, I know you like to say, most of you, I don't know. I hear often, I drive my cars for 10 and 12 years. Okay, well, you're married. She does the same thing. That means you are buying cars every 5 or 6 years. So if you've been driving for 20 years, you financed 4 cars already, just you and your spouse, that's 8. You're going to finance another 8, that's 16. You probably got children, you're going to finance the first couple for them to show them how it's done. Now we're getting up to about 18 or 20 automobiles. So it's not one automobile. It's how many automobiles you're going to finance over your lifetime. So when you put money into a cash value dividend paying life insurance policy and you have access to that money, it's how many times can you use that money over and over and over and over and over through your lifetime. It's called velocity, the velocity of money. Right? It's an economic term. That makes sense what I'm saying? Now, you know, if the PowerPoint was working, I could, point a lot of these numbers out and all this. No, it's okay. I mean, I appreciate you though. I mean, I'm already worked up because it doesn't work. You know, I feel bad. I'm like, look, y'all came in here, took your time, and I don't even have the big PowerPoint for you. Yeah, it doesn't. No, it's another PowerPoint on there. But anyway, okay. Does that make sense what I've said so far? Okay, so the comparison is a qualified retirement plan. You put your money in there. The only reason why any of you are using self-directed IRAs is so you can use your own God-given abilities and talents to get a higher rate of return and control the deal. All right? All right, the comparison is putting your money into high cash value dividend paying life insurance so you have access to that cash value, and then you using your God-given abilities and talents to go out and make the rate of return. Right? But whenever you control the banking function or the banking process, right? Because you don't control it with a qualified retirement plan, and you don't control it with a self-directed IRA. You have more control than maybe other situations. But when it comes to borrowing against your capital, because that's what you're doing, you're using the insurance company's money, and you're collateralizing your cash value, then you control that. You tell the insurance company when you're going to pay it back, how you're going to pay it back, if you're going to pay it back. You control the banking function, right? And that's extremely powerful. Yes, sir? I can hardly hear you. I'm sorry.
I respectfully request that you take the PowerPoint because I think a lot of us have heard this. Well, I've heard this concept before.
Yes. This will be accessible for you, but it's going to be about probably 60 to 90 days. If you will, that's all I've got for you. You know, if you want to give us your information at our booth, we'll send you an invitation where you can log into that on your own time and watch that. But I would not send you my PowerPoint. Okay. Yeah, my PowerPoint's not. It's their equipment. I didn't bring my equipment. But yes, you understand it? Yes, I'll do my best to make it available to y'all as soon as possible. Okay, but I'm saying 45 to 60 days. Okay? This isn't the first time. I mean, look, we have webinars all the time. You can go out and you can log into a webinar. Just did one last week with 600 real estate investors all over the country from a lady, her group, she operates from Panama. I mean, have you read the book? Well, I'm glad perfect. Because that's what I'm trying to do today. And I have talked about concept, is get the concept in your mind just enough that you'll buy a book and a DVD, read the book, watch the DVD, and decide for yourself if it's worth implementing into whatever it is you're doing. Okay? Are there any other questions? Nope. All right. Yes, sir.
Yeah, I had a life insurance note on LinkedIn. He would be trying to sell me on this, and everything. And you talked about the high fees, the 401k. So I have a solo 401k with minimal fees. But he's so motivated and everything. My suspicion and everything is that he's getting a lot of fees on the front end of selling a life insurance policy to get me on this program.
Right.
And that,
that you're hesitant.
Yeah.
Right. Okay. He's on LinkedIn. He's friends, or he has a life insurance salesman that has encouraged you to buy this concept, but he has a solo 401k, an IRA, very low fees, and so and then the agent makes a lot of money, so you don't want him to make a lot of commissions on you. Is that about right? Is that a fair?
I don't care if he makes money. I don't care about what's net from it.
I don't want to change it. Yeah.
But he's very, like just very aggressive as far as
right? Yeah. And God bless him. Look, have y'all seen that movie, Groundhog Day? Right, Bill Murray. Right. You remember Bill Murray's walking down the street, and that Ed guy from high school comes up. He's got a fedora, long coat. Ned from high school. Hey, I sell life insurance. I mean, that's the image of a life insurance salesman, right? Oh my God, I'm going to die without you buying something because I'm living and dying on commissions, right? God bless them, I guess, if that works for them. And I don't care what you're doing with your money. I don't care if it's in a solo IRA, a Roth IRA, a 401k. Look, you can bank with anything. You could bank with your 401k, right? That's right. You can bank with gold, silver, land. You can bank with CDs. You can bank with anything. Why in the world would you consider life insurance? Right? And there is a startup cost. The first 2 years, oh my gosh, you would think that, they're trying to put their kids through college on one account. There's a loss of liquidity in the first year and the second year. The third year, the loss of liquidity goes away. Between the 5th and the 10th year, whatever you put in premium into that policy, you have 100% access to that capital. Okay? So there is a loss of liquidity. Okay. Well, look, life insurance designed this way operates like a pre-engineered tax-free trust. There's 3 parts to a trust. The grantor, right? He put the money in. He structured the deal. The trustee manages the assets for the benefit of the beneficiary, right? Who the grantor chose, right? And then you got the beneficiary. Life insurance, you have the owner. He put the capital in. You have the life insurance company. They're managing all those cash values for the benefit of the beneficiaries who the owner chose, right? So, and if I continue on that, you put money into a life insurance policy, that company has to put that money to work because they have to meet the future obligations, death benefit, cash values. Those are direct obligations to the insurance company. They have to put that capital to work, right? And they have to have it liquid, dollar for dollar, whatever you have access to, they have to, by law, have a legal reserve of that liquidity. And yes, they pay the agents. And yes, they pay all their staff that has to be in place over that 100-year time period that they're managing that money for, right? So the further out you go, once you get past that loss of liquidity, the better it looks. But, you tell me what the market's going to be tomorrow.
I don't care.
You don't care?
Well, I should say that, but I don't.
How about the real estate market?
Yeah.
Where's your money in and I don't mean, I'm just, look, you tell me how liquid the real estate market is when it's down. You tell me what the market's going to be next year, 10 years from now, 5 years from now, whenever you need access to your capital. I don't know either, right? And I'm with you. I don't care. I could care less as long as I control the money. Okay. You know what? I'm going to throw some numbers out there for some of y'all. Okay, I don't know. This won't necessarily satisfy you, but you've seen the concept. I've got a 39-year-old guy. He's just a standard standard life insurance policy. He pays in $20,000 in premium. He's got $1.1 million in death benefit, and he has access to about $1,500 at the end of the year. All right. When you say life insurance, that's what the kind of numbers that come to mind. What I'm talking about, the same guy, 39 years of age, he pays in $20,000 in premium. He's got access to about $13,500 at year one, 30 days. I put the premium in, I have access. That's a loss of liquidity. Who would ever want to go lose 35% of their money? Well, it's not a loss of money, it's a loss of liquidity for a time period, right? Well, here's the reason why anybody would consider doing this. In this example, you can have this. $20,000 a year for 7 years. He's put in $140,000. He has access to $130,000. Then he quits paying a premium forever. And that money continues to grow. The internal rate of return on here, tax-free, is about 3%. And it can be higher. 3% tax-free. So the tax equivalent to yield to that is whatever your tax bracket is, right? Okay. Now, the same policy, if the guy did pay a premium in the 8th year, he could lower his premium to about $6,600, and the increase that year would be $10,000. So with this concept, not only do you create a pool of money that you have access to, but then you've created a cash flowing machine that gets better and better and better over time. So now, if you had one of these, you'd stick them right in the middle of your real estate cash flows and amplify your cash flows without losing control or money. Does that make sense what I'm saying? So in the 10th year, this guy, in the 15th year, the further out that I go, the better it looks. This guy paid a $6,600 premium if he wanted to, and the only reason why he would is because there would be an $11,000 increase that year in the cash flow. You put 6 in, it increases by 11. Now you tell me where you can go do that. Year after year after year after year. The guy, and this guy's 39, right?
They're not on 6, but on all the.
Absolutely, absolutely. But all of that aggregated cash value could be outstanding in real estate, creating the cash flow that you're running through this. There's no magic to this. There's no question. You're right. Where did that increase on an annual basis come from? It came from all the previous premiums that you paid and all that accumulated cash value and the dividend. Right? Where can you go write a check today for about $7,000 or $8,000 in 12 months? See, $12,000, $14,000 increase. Thanks for watching. If you enjoyed the video, leave a like, and if you think it was helpful, share it with a friend. If you want to see more videos like this, then subscribe down below and click the bell icon so you can be notified when we release new videos. And we are releasing new content all the time. Don't miss it. Thanks for stopping by.